Gold and silver are not rising because of hype. They are rising because something deeper is breaking beneath the surface of the global financial system. When precious metals move relentlessly, not in short bursts, but in steady, persistent trends, they are sending a message. And right now, that message is getting louder. Historically, gold and silver don't react to headlines. They react to loss of trust, trust in currencies, trust in central banks, trust in government debt, trust in the idea that policymakers are in control. When that trust weakens, capital quietly moves toward assets that exist outside the financial system. That is exactly what we are seeing now. Despite official claims that inflation is under control, real-world prices tell a different story. Food, housing, insurance, healthcare, and energy remain stubbornly expensive. Even when headline inflation slows, purchasing power does not recover. Gold reflects that reality. It is not betting on inflation today, it is hedging against currency debasement tomorrow. The rise of gold is also a verdict on central banks. Years of money printing, emergency interventions, and debt monetization have pushed the global system into a corner. Central banks can no longer raise rates aggressively without breaking markets, governments, or banks. They also cannot cut rates freely without reigniting inflation. This policy paralysis is bullish for gold. Silver tells an even more interesting story. Unlike gold, silver is both a monetary metal and an industrial input. Its rise signals not only monetary stress, but also supply constraints, geopolitical fragmentation, and the growing cost of energy and infrastructure. When silver rises alongside gold, it suggests the system is under strain from both financial and real economy pressures. Another key signal is who is buying. Central banks around the world have been accumulating gold at record levels. This is not speculation, it is insurance. It reflects a desire to reduce exposure to the US dollar-centric system and to geopolitical risk. When central banks buy gold aggressively, they are quietly admitting they trust physical assets more than paper promises. Gold's strength also contrasts sharply with risk assets. Stocks rely on growth, earnings, and confidence. Gold rises when confidence erodes. The fact that gold is strong, even when equities appear resilient, suggests a divergence, surface optimism versus underlying fear. This is not a short-term trade. Relentless moves in gold and silver usually precede major transitions, shifts in monetary regimes, debt restructurings, or long periods of financial repression. Precious metals tend to move first, before the crisis is obvious. Gold and silver are not predicting the exact timing of a crash. They are signaling direction. They are telling us that faith in fiat systems is weakening, that monetary discipline is gone, and that the global economy is entering a more unstable, fragmented phase. In simple terms, the metals are saying this. The system looks stable, but it isn't. Liquidity still exists, but trust doesn't. Paper wealth is growing, but confidence is shrinking. That is why gold and silver keep rising quietly, day after day, month after month. They are not celebrating prosperity. They are preparing for uncertainty.